Are you tired of entering trades only to see them reverse against you? Wondering why the support you bought at suddenly turns into resistance, leaving you scratching your head? If yes, this video is for you. Today we're diving deep into the flip zone strategy, a game-changing technique that every Forex trader, beginner or advanced, must master to dominate the charts. Stick around, and you'll not only learn how to identify the right flip zones, but also avoid costly mistakes others make. Let's get started. What is a flip zone? A flip zone is a key price level where support becomes resistance or resistance becomes support due to the shifting dynamics of buyers and sellers. It is a cornerstone of the smart money concept, SMC, and represents areas where institutional traders take action. There are primarily two types of flip zone. 1. Demand to supply. Demand to supply flip zone occurs when a previously strong demand level is broken, with a decisive bearish breakout, signaling a shift in market control from buyers to sellers. And upon retest, the zone transforms into a supply area where rejection patterns, liquidity grabs, order block mitigations, or imbalance fills confirm short entry opportunities in alignment with bearish market structure and institutional intent. But 2. Supply to demand. A supply to demand flip zone occurs when a key supply level is broken with a strong bullish breakout, indicating a transition in control from sellers to buyers, and upon retest, the zone acts as a demand area where rejection signals, liquidity manipulation, and confluences like imbalances or Fibonacci levels validate long entry setups in alignment with bullish higher timeframe structure. We'll explain in depth later in this video. Moving on, step-by-step guide on how to identify flip zones. 1. For a flip zone to be valid, it must align with a well-defined market structure that clearly reflects the underlying trend before the support, demand, or resistance supply is broken. 4. Demand to supply flip zone. The market must be in a clear uptrend, forming higher highs and higher lows, indicating sustained buying momentum. Identify a strong demand zone, support, where buyers consistently pushed price higher in previous reactions. Observe a shift in structure when the price fails to create a new higher high and instead breaks below the most recent higher low or demand zone, signaling the start of a downtrend. Secondly, supply to demand flip zone. The market must be in a clear downtrend, forming lower highs and lower lows, indicating sustained selling momentum. Identify a strong supply zone, resistance, where sellers repeatedly pushed price lower. Look for a structural shift when the price fails to form a new lower low and instead breaks above the most recent lower high or supply zone, indicating the start of an uptrend. Keynote for market structure. The break-in structure, BOS, confirms a shift in control between buyers and sellers. Ensure this break aligns with higher timeframe trends to filter false moves and improve accuracy. 2. Strong break with momentum. A break with body and not wick. Once the key support, demand, or resistance supply level is identified, watch for a decisive breakout characterized by full-bodied candles that close beyond the level, no wick-only breaks, and preferably a break with more than one candle closing outside the zone. Increased volume, which signals institutional involvement. Momentum, which ensures that the breakout is sharp and leaves behind an imbalance, fair value gap, or a void in price, reflecting a lack of opposing orders. Weak or indecisive breaks, e.g. small candles with long wicks, are unreliable and often lead to fakeouts. 3. Retest of the flip zone. After a strong breakout, price often returns to retest the broken zone, now acting as a flipped level. This retest provides confirmation of the role reversal. For demand to supply flip zone, the previous support now acts as resistance where sellers defend the level, and supply to demand flip zone. The previous resistance now acts as support where buyers step in to hold the level. Next, how to identify high probability flip zones. 1. Alignment with higher timeframe. To identify high probability flip zones, ensure they align with the higher timeframe trend, where price structure confirms the broader market direction, e.g., bullish or bearish, as this validates institutional intent or order flow and reduces the likelihood of false flips. Also provides context for entries that coincide with key structural shifts, such as a break of higher lows in a bearish trend or lower highs in a bullish trend, with added confluence from order blocks, imbalances, or Fibonacci retracements. If you're trading on 4 hours, you can observe market trend from daily or weekly, And if you're trading on 1 hour, you can confirm market structure from 4 hours. 2. Alignment with key levels. High probability flip zones often overlap with key levels that have been tested multiple times as strong support or resistance, as these levels hold significant institutional liquidity and order flow, making them more likely to act as reliable zones when flipped, especially if they coincide with psychological price levels, volume profile, or trendline intersections that amplify their importance. Alignment with liquidity sweep. A high-probability flip zone typically forms after a liquidity sweep, where the market manipulates stop losses above a resistance or below a support to accumulate orders, ensuring the zone has enough liquidity for a sustained move. And during retests, a secondary liquidity sweep, inducement, or lack thereof, often determines if price respects the flip zone or seeks liquidity at the extreme high-low before reversing. 2 areas to watch out for liquidity sweep. 1. Before the flip zone forms, look for liquidity grabs, e.g. stop hunts or wicks, that clear out previous highs, lows near the potential flip zone. 2. Before retest of flip zone, watch for the market to induce liquidity, e.g. small pullbacks or short-term highs, lows, just before reaching the flip zone. If liquidity is not swept, the flip zone might break and price may head toward the extreme zone, last major high or low. Before we continue, don't forget to subscribe. We will look more into liquidity sweeps in our future videos. Stay tuned. Finally, confirmation and entry. To confirm and enter a trade at a flip zone, watch for reversal candlestick patterns, such as a shooting star, bearish, bullish engulfing, or pin bar, as these formations indicate rejection and institutional defense of the flip zone. Or go to a lower time frame and enter on a change of character and place stop loss few pips above or below the zone. For this example, we have a high probability pattern, a shooting star with a long upper wick at the supply flip zone, and can be traded by entering immediately after the candles close without requiring additional confirmation and target the next support as take profit. Let's look at more examples on a live chart. Here on Gold USD 4 hours time frame. The market is clearly in a downtrend, forming lower lows and lower highs. We mark out the supply range zone, an area where we expect price to react from and form a new lower low to continue its bearish movement. However, instead of forming a new lower low, the market reversed and broke out of our supply zone, closing above the last lower high, LH. Multiple candles printed above the supply zone, validating the break and confirming that this was not a fake out or a liquidity sweep. At this point, we mark out the newly formed flip zone. Upon closer observation, we see that the market swept liquidity from the previous zone when forming the flip zone, increasing the probability of this trade. We now identify the unmitigated demand zone within the flip zone, where we expect price to react and continue its bullish reversal movement. We wait for the market to return to our flip zone. After some time, price reaches the flip zone and forms a bullish engulfing candlestick, signaling a potential long entry. To refine the entry, we switch to a lower time frame, 15 minutes. On the 15-minute chart, we observe that price has already formed a new high and broken it, signaling a change of character, C. This is the confirmation we want to see on the lower time frame. At the same time, we notice an unmitigated lower demand zone, so we exercise caution as this could also be tested. We enter the trade, place the stop loss below the demand zone, and set our target at the next major resistance zone, or aim for a 1:3 risk to reward. To capture more profits, we use a trailing stop, allowing us to secure additional gains as the trade progresses. Finally, as I always advise, manage your open positions carefully, take partials when necessary, and let the rest of the trade run. Eventually, the market hits our take profit, TP. So let's look at another example. The market is in a downtrend, consistently printing lower lows, LLs, and lower highs, LHs. So we mark out the supply range or supply zone, where we expect price to react and form a new lower low, continuing the downtrend. However, upon reaching the supply zone, the market reacts briefly, but eventually breaks through the supply zone and printing multiple candles to confirm the break, and in the process formed a flip zone, a new demand zone. Next, we mark out the newly created flip demand zone and wait to see how the market reacts when price returns to this level. Eventually, price reaches the flip zone and forms a hammer candlestick pattern, a classic bullish reversal signal. Upon closer observation, we notice that the market grabbed liquidity by taking out an order block near the zone, which is also a retracement on the lower time frame, significantly increasing the probability of this trade. For this trade, we use the candlestick entry method. To learn how to trade with different candlestick, check on our previous videos. Moving on, and since the hammer candlestick is a strong reversal signal, it does not require extra confirmation for an aggressive entry. We place a buy limit just below the body of the hammer candlestick and let the market play out. We manage our open positions carefully, securing partial profits when necessary, and eventually, the market reaches our take profit level, completing the trade successfully. That's it, traders. The flip zone is a powerful tool when understood and applied correctly. By focusing on market structure, key levels, and retest confirmations, you align yourself with the moves of smart money. Now, it's your turn. Practice these steps on your charts and share your progress in the comments below, and let us know the topic you want us to cover next. If this video gave you clarity, smash that like button, subscribe for more deep dive trading strategies, and share it with your trading community. Remember, trading success comes from discipline and continuous learning. See you in the next video. From DMFX Trading School, happy trading.